In this video, you will see all the keys of why the market has not collapsed yet and when it is most likely to happen. For a while, we have been reporting that the financial market is in trouble, that a kind of shock is looming. We have several videos explaining the data, and people were worried, wondering what would happen if that shock or fall really occurred. But nowadays, the conversation has changed. Most people believe that if that shock happens, it won't be as strong as we thought. It's called a soft landing. In other words, a severe economic recession where people lose their jobs and there is not as much money to buy things is not expected. But there is an important detail that many have forgotten in financial matters. Sometimes, the paranoid and cautious are the ones who survive. If you take a look at the current financial market, you will see that it is near its highest point in history. But is this really true? Some indicators show that it may not be as stable as it seems. Let's explain some key numbers and concepts. When we talk about interest rate hikes, we refer to how much it costs to borrow money. Well, this graph shows how quickly these rates increased over time. From 2015 to 2018, they only rose by 2 points, which was not so drastic. Between 1999 and 2000, they increased by 1.51 points. Between 2004 and 2006, they rose by 3.96 points. And between 94 and 95, they increased by 2.67. Between 88 and 89, they went up by 3.23 points in just 2 years. But nothing compares to what we are seeing now. We have a 4.88 point increase between 2022 and 2023, the fastest rise in any other period in history. The graph above shows how many bonds the Federal Reserve has been buying, and below the M2 monetary supply, which is the amount of money in circulation in the economy. If you notice, until 2020, both curves were gradually rising with no abrupt changes. But suddenly in 2020, we introduced a massive amount of money into the economy, something we were not accustomed to. Why? Well, it was in response to the crisis caused by the pandemic. The government and the Federal Reserve injected billions of dollars into the economy to prevent a financial collapse. The important question is, what happens after injecting so much money into the economy? And here is where uncertainty comes into play. We don't have a recent example to say with certainty what will happen. In the past, when money was injected into the economy, there was a risk of inflation, the increase in prices of things shooting up, and today, that's the case. We are at levels not seen since 1981. Now let's talk about the projections for 2024 and opinions about a possible recession. According to a survey, opinions vary. Representatives of the Federal Reserve confidently state that there will be no recession. Still, it's important to remember that this is what Wall Street is expected to say. On the other hand, Wall Street estimates a 61% chance of a recession in the next 12 months. Economists have a more cautious view, with 48% of them believing that a recession is likely. 69% of consumers, people like us, express concern about a recession. As for large financial institutions, their outlook varies. Goldman Sachs has an optimistic opinion with only a 15% chance of a recession, while Bank of America is more cautious, estimating a 35-40% probability. This shows that even experts cannot predict with certainty what the economic future holds. Opinions vary too much, which is understandable since the economic situation is influenced by many factors and unforeseen events. But let's take a look at what CEOs, the leaders of large companies, think. An impressive 84% of them believe that a recession is looming in 2024. This raises the question, what do CEOs know that the rest of us don't? It could be a crucial clue and worth investigating further. Perhaps they are thinking about how they will deal with the expenses of their debts. Before, you could get loans with much lower interest rates than those currently in play. So if they have to borrow again, it raises concerns about how they will handle repayment in the future. To better understand the CEO's perspective, maybe we should pay attention to what they say in quarterly earnings reports. From the second quarter of 2022 to the third quarter of 2023, keywords like inflation, cost of materials, and economic slowdown have decreased. However, job cuts have increased, although they have been decreasing in the last 2 quarters. So, it could be a sign that everything is going to be fine. It's a very good question, but it clashes with the belief of the 84% of CEOs that a recession is coming. Are these CEOs like Houdini or Nostradamus able to see the economic future clearly? They have access to information and data that the general public does not, which could explain why their opinions are contrary to more optimistic views. Now let's talk about the S&P 500. which comprises the 500 largest companies in the United States. Here's where things get even more interesting. Look closely at the history of the S&P 500. Never before had 7 companies represented 28% of the index. These 7 companies are Facebook, Nvidia, Apple, Microsoft, Alphabet, Amazon, and Tesla. The importance of this lies in how these 7 super companies influence the performance of the S&P 500. If we observe the index's performance to date, we notice an increase of around 12.4%. However, this doesn't completely reflect the situation. The actual performance of these 7 mega companies has been exceptional. As a group, they achieved an average return of 92% in 2023. Now, if we remove these 7 stocks and only consider the other 943 in the S&P 500, the landscape changes. It has gained less than 1.8% after eliminating these 7 outstanding ones. This raises an important question. Are these 7 companies dragging the rest of the market down? It seems so, but what about the rest? To get a more complete picture, it's crucial to observe how small and mid-cap companies are faring and compare them with the giant large-cap ones. Look at this chart with 3 indicators. The SPY, which follows the S&P 500 and includes companies with a market value of around $12.7 million or more. The 500 largest companies in the US. The Russell 2000, which groups companies with a market size ranging from $3 billion to $2 billion, and the microcap, covering companies with a market value of $50 million to $300 million. If you take a look, you'll notice that the SPY has increased an impressive 18.66%. It seems like the rich are getting richer, the giants are growing more, and the strong are becoming even stronger, right? On the other hand, the Russell 2000 has only risen by 7%. But what's most interesting is what's happening with microcap companies. Instead of gaining, they have decreased by 1.85%. So why can the giants weather a period like this without problems, while the smaller ones cannot? The key lies in the amount of cash and capital they have at their disposal. However, we shouldn't be fooled into thinking that the market is rising just because these 7 mega companies are leading the charge. While unemployment is very low, reaching its lowest point in 50 years, which means most people have jobs and can pay their bills, this doesn't mean there are no reasons to worry, and this is where the third point comes in. Consumer credit card debt in the United States has surpassed $1 trillion. Yes, you heard it right, $1 trillion, the highest it has ever been in US history. It's not something new, we've been using credit cards for years. But if you take a look at this graph, you might start to worry a bit. This graph shows credit card interest rates in blue, US 5-year Treasury rates in orange, which are higher, and the difference between them in gray. What should really catch our attention is that credit card interest rates are at their highest. As bond rates increase, so do the interest rates on your credit cards, meaning you're paying more for your debts. Imagine you have a total credit card debt of $333,000. With each increase in rates, your payments become more and more expensive. You may have initially planned to pay $300 per month, but now you find yourself having to pay $400, $420, or even more, let's say $580. This is not a good sign, as people's interest payments are reaching record levels. Now, I have to give you some bad news, especially for the 30 or 40 million American students who are repaying their student loans. Remember when the government said, "Don't worry, we're postponing student loan payments due to the pandemic"? Well, that's over. Starting from October, loan payments have resumed. This means that between 30 and 40 million people will have to allocate an extra $300 per month to repay their loans. Add that to all the other monthly expenses and it's easy to go crazy. But some say that precisely this is the reason why the market won't collapse. Let us show you the argument behind this. Look at this chart. It shows the average mortgage rates, which have skyrocketed, hovering around 7%. In some cases, they even reach 8%. This is an increase of about 4 to 5% compared to the ultra-low mortgage rates we had in early 2022. With such a high rate, demand should decrease, causing home prices to drop. But that's not what's happening. Why? Because homeowners don't want to sell their homes. They secured a mortgage with a rate of 2 or 3% years ago and don't want to sell and buy at a rate that's more than double. So people cling to their low-rate mortgages as if they were a treasure. But now comes the big news. Do you want to know why the market hasn't collapsed? Look at this graph. The blue line represents the interest rate of the United States, and the gray bars indicate recessions. In black, it's marked when the Federal Reserve stopped raising interest rates, and after approximately 6 to 15 months, the economy always enters a recession. In other words, from the moment the Federal Reserve stops raising interest rates, it takes about 11 months for us to see a recession. Let's assume the data is accurate and says that the Federal Reserve raises interest rates in November. Counting 11 months forward, we land in October 2024, 1 month before the elections. According to this graph, we should expect a recession in the United States. But if this is the case, why aren't we seeing more companies going bankrupt, as happened in 2008? The answer to that is interesting. Back then, companies were taking massive loans from banks, literally billions of dollars, because money was incredibly cheap. However, what they did with that money is quite surprising. Instead of spending or investing it in their business, they simply hoarded it. They didn't give it an immediate use. What they did with that money was buy bonds. These bonds paid interest, and the difference between the interest rate at which they borrowed the money, let's say 3%, and the interest rate they earned with those bonds, for example 6%, represented their source of profit. In other words, they were earning an additional 3% on the borrowed money. If they borrowed $50 million at 3% by the end of the year, they were earning $1.5 million in interest. It was like having a gold mine generating additional income. However, the problem arises when interest rates finally rise, as has happened in the past. Let's say rates go from 3% to 8%. That's when these companies face serious problems. Suddenly, they have to make much larger payments on their loans, and they're no longer making as much money from the bonds because interest rates have risen. So, their source of profit is drastically reduced. Now, what do? Well, these companies find themselves in the need to either pay if they have the money, or, if they don't, tell the banks, hey, can we wait another month? Can we wait another 2 months? This is why a company called WeWork, which in 2017 had a market valuation of $47 billion and received a $17 billion investment from SoftBank, missed a $95 million payment this month. Although we haven't seen many cases of default like this yet, it's something that will soon become a trend. So, let's see what effect the delay in repaying the loan that companies took can have. Let's take a look at this graph. The graph shows the year when companies have to repay the debt they incurred by taking loans. In the remaining months of 2023, there are approximately $230 billion left to pay, equivalent to a total of about $530 billion in corporate debt payments in 2023. But here comes the interesting part. Look at what is projected for 2024. They have to pay around $790 billion. By 2025, the figure rises to $1.1 trillion, and so on. Estimates indicate that by 2027, we'll be close to $1 trillion in corporate debt, and in 2028, it will approach $1.3 trillion. The question is, how will they cope with this abrupt change from $230 billion in interest payments in 2023 to over $1.3 trillion in 2028? So, when we initially saw who the least optimistic are about the possibility of a recession, the answer is clear. 84% of CEOs. This may be because these business leaders have a deeper understanding of the looming debt. Even the average citizen could be affected by the rising interest rates. Imagine if you have a student loan and suddenly your monthly payments skyrocket to an unprecedented level. That can be lethal. And it's not limited to individuals. Defaults on commercial real estate loans, such as offices, are increasing as many workers remain in remote work. Similarly, high-risk auto loans are now more challenging to provide to dealerships because such high rates make it more likely that customers won't pay, and banks prefer not to grant loans. So, dealerships sell fewer cars. All of this adds to concerns about an impending uncertain economic outlook. Now, let's look at one last thing. Do you know who owes the most money in the world? The United States of America. All corporate debt will seem small compared to what the United States owes. Breaking it down, the government has a national debt of around $33 trillion. If we do some math, you'll realize that every 1% increase in interest rates translates to an increase in what the government spends on paying interest on that debt. Around $320 billion additional dollars for each 1% increase in interest rates. This doesn't affect the total amount of debt, but rather the interest we have to pay on that debt. For a clearer idea, take a look at this graph showing US interest spending from 1970 to today. You'll notice a gradual growth without major disruptions, but suddenly, boom, it shoots up. How are we going to deal with these payments? No one knows the answer, but sooner or later it will fall on its citizens as the government is paid through taxes. Take a look at this graph for a more comprehensive view of the situation. The green line represents the annual tax revenues the government receives from its citizens through taxes. The orange reflects the gross domestic product, GDP, that is, the money generated by the country. The blue is the payment of interest, meaning the amount of money the government has to allocate to pay the accumulated interest on its national debt. And the red is the debt, amounting to $33 trillion. In 1980, all these elements were more or less aligned side by side just 43 years ago. However, suddenly we observe a sharp increase in the red, representing the debt, while the GDP has remained in steady growth, and worst of all, interest spending has skyrocketed to unprecedented levels. This is where we are. But no one complains about the lack of fiscal responsibility. Regardless of who leads the government, there is a tendency to spend without restrictions. We are in this situation because we have chosen these leaders, and they are managing the finances of the United States in a way that their follies will be paid by us. Remember that in financial matters, sometimes the paranoid and cautious are the ones who survive. Thanks for watching, guys. I hope you enjoyed the video. Please leave a comment. Also, please consider liking and subscribing. I would really appreciate it. Thanks.